Hi and welcome to On the Record, your playbook for tapping India. Today we will look at in detail and try to decode how a ESOP or a stock option strategy should be for a US based company. So there are multiple kinds of equity compensation that a company can follow based on their goals, the kind of people they are working. ESOP generally stand only for employee stock option plans, so I'll be focusing more on stock options. We'll look at how other stakeholders, not just employees, but also consultant, advisors, mentors, directors, partners, vendors. Anybody can be given stock options depending on the company's need. As all of you know, like stock options primarily goal is to attract and retain great talent so that everybody makes money or can see the upside or grow together. So as the company grows, everybody makes money, and in the early days also the companies don't have too much money to attract the best of the talent. So it has been proven to be one of the best way of attracting and retaining talent. See, in stock options, there are three major steps. The first one is grant of options. So this is the date. Typically, generally, like anybody, whenever they join the organization, you grant them a certain number of options with a vesting schedule. So you have to earn those stocks. So basically, once the vesting schedule is done, and vesting can be like not just a time based, it could also be performance based or goal based or metrics based. So whenever a vesting milestone is reached, so for example, if it is time based and if you reach a year of milestone, or if it is a monthly thing, after that much options you are eligible to exercise. So you have to exercise that option, then only it gets converted into stocks. Till that time it remains just as an option. And then the third event is once you have exercised, then you are free to sell, because now you have got the actual ownership of the stock. So you can go ahead and sell it, provided if there is a buyer. Now if it is a listed company, it's so easy because you can just go to the stock exchange and sell it. But if it is private unlisted companies like startups and all, then probably you may not have a ready buyer available at any point of time. So there are instances happens where companies also help people, like if a new set of investors are coming, so they plan exit event, or if you find some other buyers, then also you can go ahead and sell it to them. There are certain restrictions associated because this is unlisted shares, so you would need probably a company's approval to sell to any third party. It's not as easy as selling as a listed company, you can sell it to anyone. So you have to go through the ESOP plan or stock option plan document to understand what those restrictions and conditions are. First, let's look at ISO. It's also called incentive stock options. These are a little special type of stock options where you get a favorable tax treatment, and since you get a favorable tax treatment, it also comes with decent amount of restrictions and limitations which the IRS implements. This is a stock option which can only be given to employees. Now employees can be full-time or part-time, but they need to be an employee. And also you can give it to your international employees. So for example, you have a subsidiary in any other country like India or Europe or anywhere else, they are also eligible to get ISOs. But remember, the favorable tax treatment is only applicable for USA employees, not for international, because international employees end up paying taxes based on the laws of their country, not of US. So from US side, they would still get that favorable treatment, but since the taxes are being paid in the home country of the employee, it does not really impact them that way. Typically, when you are granted a stock option, you are granted at the then fair market value of whatever the stocks are. So let's assume on the date when you were granted stock options, the fair market value was $5. Now after a year, when it is vested, and suppose if the employee choose to exercise it, say you had got 1,000 options vested, so you have to pay $5,000 to the company, and then only you will get the stocks from the company. On the date when you are exercising the option, if the stock price is say about $15 a stock, so effectively you are getting 1,000 stocks which is worth $15,000, and you are only paying $5,000 for it. So effectively there is a spread of about $10,000. So this $10,000 is considered as your income in majority of the scenario, and you are liable to pay a tax on this income, because this is the point of time when you are actually accrued or you have received that much benefit. and you end up paying a tax at your regular income tax rate. Say you held the stocks for some more time, say about another 6 months, 1 year or 2 years, and when you are selling the stock, let's assume the fair market value of the stock or the sale price of the stock is say $50. So you will be getting $50,000. Now, when you sell the stocks for $50,000, your cost of acquiring those stocks is $15,000 because $5,000 you paid and $10,000 was already added as your income. So your effective cost becomes $15,000. So the difference in price or the capital gains would be computed only on $35,000, and you will end up paying a capital gains on $35,000. Not on the $45,000 or $50,000. So income tax would be paid on the $10,000 and capital gains would be paid on $35,000 when you are selling the stock. Now you may end up paying long-term capital gain or a short-term capital gain depending on how long you are able to hold. Now coming back to ISO, there are 2-3 special conditions that you have to remember. First is when you exercise, you don't end up paying an income tax. That's where you get a favorable tax treatment from the government. That means there is no tax that you have to pay on $10,000. Now, if you are selling that same stock for $50,000, at that time you will end up paying a tax on $45,000, which is the $50,000 is the sale price and $5,000 is what you paid for it. The difference of $45,000 is eligible for capital gains. Now there is a condition associated with it. If you sell the stock 1 year after vesting or 2 years from the date of grant, then you are eligible to pay tax at a lower tax rate of long-term capital gains. Otherwise, you will end up paying a short-term capital gains on it. So effectively in ISO, you don't end up paying a tax when you are doing exercise, and you will only end up paying tax when you are selling the stocks. So another restriction which is given is when you are giving the stock grant or when an employee is receiving a stock grant, at that time per year, the number of options that they are getting, the fair market value should not be more than $100,000. So in our example, if the fair market value on the date of grant was $5, if you are getting anything under 20,000 options, which is like 100,000 worth of thing, then ISO would be applicable. For example, if you are getting 30,000 stock options, then the effective value is 150,000. Now when you exercise, up to $100,000 benefit is what you can claim under ISO. The balance amount will be considered as something called NSO or non-qualified stock option, and there is a different tax treatment to it. So in our example, if the stock price on the date of exercise was $15 and you got 30,000 options, so your effective price is $450,000. So $100,000 worth, that is 20,000 into 15, that is $300,000 will be considered as ISO options, and the balance $150,000 would be considered as NSO options. In that case, you will end up paying a tax on $150,000, which is the NSO component, considering this is your normal income. And when you sell it for $50, 30,000 into 50 is 1.5 million. So you will end up paying a tax accordingly. At the time of selling, the computation has to be done suitably. Whenever you exercise your ISO side of things, irrespective of whether it is 100,000 or less, you are still liable to pay. There is something called alternate minimum tax, AMT. So let's go back to the example. If you are getting say 1,000 options, the stock price during exercise was $15,000. So you will treat that $10,000 as your income. You will also compute your AMT, alternate minimum tax, and pay AMT amount to the government. Now this AMT amount can be adjusted with future credits. Like in the future years when your regular tax is lower, you can adjust it with AMT. So that is an advantage, but at the time of exercise in that year you have to pay an AMT for ISO side of things. So this is broadly about ISO. So based on this, based on your financial goals and where you are, you should plan. So as soon as it gets vested, you need not necessarily exercise it. You can defer it if you are continuing to work for the organization, or even if you are leaving based on again the plan terms and document. If you have a longer exercise period, you can choose to exercise. The best way is if you try to exercise it at a time when you see a foreseeable exit. That is the best way to make money out of ESOP. Because of unlisted companies, you may actually exercise the stock, end up paying huge amounts on taxes, and there is no buyer available. And it could happen that for multiple years there is no buyer available. And since these are startups, you also don't know in tomorrow's date the company will continue to rise or the stock prices would fall. So it is best to be observant and try to exercise whenever you see there is a foreseeable exit that is possible. So you can exercise, and you can also exercise part options. You need not exercise all the options as well. Now let's look at one of the most popular option category, which is called NSO or non-qualified stock options. Even sometimes it is also referred to as non-statutory stock options. Now NSOs have a lot of flexibility in terms of whom you can give. So you can give it to employees, you can give it to directors, advisors, mentors, consultants, contractors. You can give it to anyone, whether in US, whether outside of US, you are free to give it to anyone. So that is one big advantage, and that is why it is also very, very popular. Now, if you remember our example, typically those are the 3 points. At the time of exercise, whatever is the spread between the fair market value during exercise and fair market value of your grant, that income is considered as your income, regular income, and you end up paying a income tax on it. And whenever you sell, you end up paying a capital gains on the difference amount. Long term or short term would again depend on the country where you are operating, what is the holding period mentioned there. So you should check those laws before deciding when to exit and how much to exit. So that's about NSOs. So in the interest of time, we are also breaking this topic because this is a complex, elaborate, and it requires a detailed, careful analysis. We'll be talking about more options in part 2 of the video. Stay tuned, we'll be launching that soon. Thank you.